Welcome to Surgeon Syndicate. If you're paying attention, you know that you only make money when you work. It might be great money, but it's dependent on you. The information on this podcast will help you solve that. We interview experts and provide analysis into financial freedom through commercial real estate. Why? To help physicians like you thrive. Let's dive in.
All right, welcome back to the show in the second half of our conversation with Michelle Jeong.
Yes.
Did I say it right? All right. Today's show is again sponsored by Fortress Capital, a private equity company that I founded to help physicians build passive income through commercial real estate. So Michelle and I were just talking about this before we started here in the middle of this interview about the purpose of that, because Michelle also operates a company that runs real estate investments. And so where did that come from? And it originally, the idea was as I have been investing passively and then actively in deals, to give a place that my listeners, if they're like, hey, I don't even know where to go, a place to land and start investing money. The show also introduces you to some other people. And so an interesting thing, this I was wondering about asking Michelle, because I just started seeing it in the last few days, is people running some great deals, and several of them are ground up. And these are the ones that seem to make docs most nervous, because it's a bigger process, but because the projections are a bigger spread. But people not having deals fill. People who have always had deals fill are having deals not fill. And it feels like people are more and more nervous and kind of holding back a little bit. Have you seen that?
Oh, yeah, very much. I mean, 2023 has definitely been probably a very weird year. I mean, economically, we're really in a fog of information, and we're getting different messages from different sectors and different indicators. So if you look at job growth and unemployment, we're still at historical lows, which obviously is a huge concern because wage pressure increases, and therefore it creates a cycle of inflation. And I had the chance, as I mentioned to you earlier, of talking with Ben Bernanke, being part of a roundtable discussion with Ben Bernanke, and the monetary policies and the changes by the Fed are very much, they're lagging. They're lagging indicators. They hike up really quickly, and then they kind of wait and see. And that's one of the reasons why June's pause occurred, because they were we're still kind of trying to tread the water and see where it's going to go. It's still expected, and I still do expect that there'll be a quarter point increase in the next. But Bernanke himself was saying September is kind of in the air. We're still trying to figure this out, and we're crossing our fingers and hoping that either the unemployment will increase slightly, or it'll show that there'll be some inflation decrease. But keep in mind, the U.S. economy is very cyclical. So our buyer demand we're leading into the next 6 months. At the end, we have Christmas and we have Thanksgiving, and a lot of Americans spend a lot of money around that period of time. So there'll definitely probably be an uptick, but that will be completely due to the seasonality of things.
You know, that's an interesting thing, because over the last 6 months, as I would talk to people, there were a lot of people who are like, rates are going to go back down. As soon as rates go back down, this deal will work. And then you listen to what the Fed's saying. They weren't talking about rates going back down. And a lot of people see economics like it's physics, but it's a social science. They do things and then wait for several million people to respond.
Yeah.
And see what kind of effect it has.
Yeah. I mean, it's kind of think of it as in the medical field, like you're testing a new drug, a new mRNA drug. And you really, you're not quite sure if this is going to land completely. It might be within the sphere, but you'll have to fine tune things. Well, we're right now in that period of time where the Fed is fine tuning things. And so they'll launch it with like a hope that it works and that it's generally in the right direction. I'm one of the more optimistic people. So the US economy has been a massive driver in the world. And the two biggest drivers that I could predict in the future is technology as well as educated workforce. And your listeners are definitely part of that. In terms of when I speak about technology, I'm not talking about necessarily SpaceX or Google or anything. I'm talking about in the biotech sphere, you have mRNA, I just mentioned, and that has created this massive opportunity to do good, to make a difference, massive social scale. And that I can definitely see as a huge driver for the economy. And one of the reasons why I'm staying optimistic. As for the drop, honestly, most people don't see that happening until sometime in like earliest second half of 2024. So
it's not a thing that's right around the corner that may save.
Right around the corner, depends.
Well, there's a few deals out there that people did based on variable rates that haven't hung on well. And if you're waiting for that short-term change, it's likely not a good thing for that deal.
Yeah, I love numbers, and I make sure that we take a very conservative approach in looking at deals, and they have to pencil out, have to protect my investors' interest. And the only way to do it is to make sure that the underwriting is extremely conservative. Our assumptions are extremely conservative because who knew that things like the pandemic would have hit, or who knew that Russia was going to invade Ukraine, or who knew all these things. And you have to kind of build in that in your model.
Yeah, and those are sometimes depending on how people put their deals out.
Yes.
And I know a lot of docs that have been like, well, why are their numbers all over the place? Why do they say the returns should be 20 to 50% with a 1 to 3 year hold? And it seems like so these are some land deals that were.
Oh, okay.
And so the variability was hard, but the reality is there's some things you don't know. So when you're doing land entitlement, is that likely you can get it through the county in 6 months, but it's a county. It might take 9 to 12 months. And that changes the percentage return significantly because it takes a lot longer. Or if you're doing entitlement for apartments, they approve you. If you've got a seller to sell that to who's building apartments, and you've got it, often will sell at a price that's per unit or per apartment. Well, you're going to the county and you're saying, well, I think we can get 270 out of this, and the county will probably approve somewhere between 250 and 280. Well, that changes your returns if you're at the 250. But as you said, if you're conservative underwriting, because I think for a lot of people still, if you're new to it, underwriting is like this black box.
Yeah.
And it's basically doing the math. And if you're saying, okay, I'm going to use a higher interest rate by a point if the loan's not done, if it works with a higher interest rate than you'll probably get. If it works with a lower number of units than you'll probably get, or it works if you're only 80% rented instead of 95.
Yeah.
Now it's a great deal because if you can now get that interest rate 1% lower, you get 95% rented. Now it's the better returns. But if you win.
No, you're absolutely right. And actually, so for your passive investors out there, one of the key questions that they should be asking the syndicators or the person who's offering a particular deal to invest in, what's the stress test? If you stress tested this deal, what is the minimum amount of vacancy, or occupancy? Or I prefer not to do variable. So I already get myself out of that equation, having to defend that. I like fixed instruments, and I'm kind of old school and traditional that way, but I'm trying to minimize as many, again, my potty mouth, WTFs. And just, there's already enough unknowns or enough variables that if I can eliminate that for my investors and myself, all of us sleep better at night.
Mm-hmm.
I usually stick with the more conservative. It usually costs more, and that's maybe the interest rate might be a little bit higher. But if I can already preset that, bake it in to my numbers, and know that for X amount of years, it's going to stay that. This is the steady amount that I'm paying. That allows me to focus on filling the beds, filling the units, remodeling the units, doing the things that are much more important in terms of asset managing a deal.
And so that, you go back a couple of years, there were a lot of people who were like, oh, well, we're going to refi this in 3 years or in 2 years. And that's where they got in trouble.
Big time.
Because the numbers didn't work anymore 3 years later.
And the cap rates have changed. I mean, like, we can talk about this a lot more, but you've got exit cap rates. I live in San Francisco, and you mentioned permits. I mean, you basically, what might be a permit issue in the length of like 6 to 8 months in Texas would be more like 3 to 4 years in San Francisco. So that being said, as long as you bake that assumption in your model, then, and the numbers still work, then great, go for it. But again, I always try to pad the numbers a bit so that it creates a lot more flexibility. And my idea is to set expectations and then always beat the expectations. And that's the only way to do that is by conservative estimates.
Yeah. And the length, you talked about the length of the loan. So if your projected hold or how long you plan on owning it is 5 years, if you do a 5-year loan, you might get in trouble. You do a 10-year loan, well, now you've got a lot more time to find a good place to exit.
Exactly.
All right. So we talked a little bit about the technology here. So I want to get back to the AI. So we talked about the economics. So AI's impact in real estate. So I think for a lot of people, AI is this new thing because when ChatGPT came along, everybody heard about AI. There's been a lot of AI stuff kind of out in the world for a long time. Tell us about what is AI and how is it impacting real estate?
So there are many different ways. Everything's still nascent. So just as AI is impacting healthcare and it's in terms of helping maybe improve customer service, greater response rate, we're talking about therapy. There's been a lot of discussion on AI's positive and negative impact on therapy and outreach for mental health issues. And it's the same way with real estate. There's a lot of people that talk, just like the .com era might date me, but it used to be in which in the early 2000s, if a company just had a .com strategy, their value would like multiple increase. We're kind of at that stage. It's very nascent. So my job is to kind of look at it from a practical and cynical perspective and see what really works and what doesn't. I created a cheat sheet that I'm happy to share with your viewers. It just came out a few days ago. And so I'm happy to share that as a free offering to your listeners. And it just basically, for the active investor, it looks at it from deal search and due diligence and the numbers and things of that nature. And I've offered different tools because I've tested all these tools out myself. I have different case studies of what works and what doesn't. It could be as simple as using ChatGPT 3 or 3.5 or 4 to better understand the best neighborhoods to invest in for your listeners in a particular city.
Okay. And so a passive investor could use that too, because then they would go look for deals that are in the neighborhoods that now they may feel more confident that that's a good neighborhood to invest in.
Yeah. I mean, you have a lot of free tools available where you can do market research on, again, I mentioned what are the best neighborhoods, but also population growth, job growth, things of that nature, because obviously you want people with a higher household income so they can afford the rents. You can also find out which states or which cities and which neighborhoods has a higher renters population because obviously you want more renters, things of that nature.